This is the London Fintech Podcast, brought to you by your host, Mike Ballerman, bridging the worlds of suits and t-shirts, of finance and technology, bringing you insights, stories, and inspiration from the golden age of opportunity and innovation happening in London right now.
Hi, this is Mike Ballerman, and this is London Fintech Podcast, episode 34. And I'm delighted to be joined on the show today by Andrew Mullinger, co-founder and global head of credit at Funding Circle. Funding Circle need no introduction, being the heavyweight SME marketplace lender in the UK and the only global player to have a large footprint in both the UK and the US. Those on the conference circuit may be more familiar with Andrew's co-founders, Samir Desai and James Meekings. Andrew has tended to stay at home with his head under the bonnet, working on the engine within Funding Circle, that of the credit underwriting process. This is not to say that other Funding Circle efforts to increase the petrol and air flowing into the engine haven't been working at full pace. When I last looked, they'd raised roughly $1 gazillion in capital, with the last E-funding round being a nice splash at $150 million. I wonder what it's like to spend all that money. Does it go on air, petrol, or an engine upgrade? Probably all of the above, but maybe we'll get to hear about it on the show. Anyway, there is, as of now, no fountain in reception, no statues of the founders, just a lot of busy people packed into an office, working hard in a hardcore business that's growing fast. SME lending is a very prosaic phrase, but one that is vital for a modern economy that's undergoing an ever-increasing bifurcation into gigantic oligopolistic corporations or smaller companies. Finance is the lifeblood of such smaller companies, and as the first line of Andrew's LinkedIn says, the aim of every business should be to change the way other people live their lives for the better, not that of the founders. They are certainly doing that, and at this rate will deservedly also change the lives of the founders and staff, as Funding Circle are on everyone's tiny handful list of big players with very short odds to IPO. Meanwhile, rather like winning a world championship in any sport, the focus has to be on the next match. And Andrew's second LinkedIn aphorism is, those who are best at organising data will win in the information age. Sounds appropriate and gives me an idea for a Christmas range of fintech-related Chinese fortune cookies. I think that could really take off. Plenty to talk about, so let's get on with the show. Hi Andrew, thanks for joining me today.
Good morning, Mike. Nice to see you again.
So, how do you like flying? As we tried setting this up about 6 months ago, and in the meantime you've got about 1 million air miles shuttling backwards and forwards daily or something like that to the US, where you're also a large player.
Probably not as much as I used to like flying. I think it's more fun when you go on holiday. But yeah, it's not too bad. I go back and forward about once a month, once every 5 weeks to the US and between the US and the UK. And
just to give listeners a feel for this, roughly how many people has Funding Circle got in the UK and how many in the States these days?
I think we're about 210, 220 in the UK and about 120 in terms of headcount in the US, so about half as many in the US.
So that's quite sizable.
Yeah.
And we were talking earlier about statistics, and it's always hard to know how much the big players in the States are doing in terms of corporate lending or whatever it's called over there. But certainly Funding Circle is up there or thereabouts in one of the major players in the United States per se.
Yes, I mean, as you say, we're not exactly sure what other players are doing, but yeah, we've worked very hard to really gain some traction, and we're certainly one of the leaders out there.
Which is really impressive. We'll come on later in the show to talking about the traditional challenges financial services companies and everything else actually has faced going to America, but so far so good. So once upon a time you kind of were a normal human being and with a normal job and that kind of thing, and then you got together in a pub, presumably with a couple of blokes, and formed a company which is now worth roughly $1 trillion a few years later. So that must be an interesting story.
Perhaps not exactly like that, but yeah, I suppose I had a more, what you could call a regular job, I suppose. So the background was I was friends with James and Samir from university times, ended up working in financial services, various different jobs, always in the sort of risk management and regulatory space. And Samir sent me an email, I've still got it today, and it said, do you want to hear a business idea?
Have I got news for you? And you said the right answer, which was yes.
Yeah, absolutely.
It's a good job you haven't got that email to which you replied, no, thank you.
No. Well, exactly. I think I would be very upset if I did have that. No, I mean, we'd spoken before, we're friends, obviously, and we'd talked about setting up a business, and James and Samir lived together as well, so James got involved fairly quickly a few weeks after we had the first few conversations.
And what was the original idea then? Because obviously Zopa had formed in about 2005, had stuck, as it pretty much is today, to doing unsecured consumer lending. And did you guys go, oh, look, there's Zopa out there, maybe somebody could do that for SMEs? Or what was the genesis of it all?
The genesis was more focused on the customers, basically. So we felt that it was around the time of the financial crisis, and we felt, or in particular Samir, thoughts were that, which was a consensus, was that there was going to be a massive deleveraging in financial services, and that always has an impact on the customers that these financial institutions were serving. And we felt in particular that small businesses were going to be affected greatly, and depositors or those who are retail investors. So we felt there was an opportunity to serve those better. Probably a few months, maybe, or a month or so after first having conversations, we were starting to do market research, and we discovered Zopa. We weren't actually aware of Zopa when we first had the conversations.
So what led you to the P2P model? Was it the online gambling stuff, which lots of people quote? Betfair and all those kind of things?
Yeah, P2P was happening exactly. So, eBay, music. We didn't pick up, this trend was quite apparent.
But not necessarily in financial services, so it's quite brave.
Yeah, correct. And I think it was we felt that there was an opportunity because of the severe loss of trust, as we thought about it, in financial services, to build a brand or build a company that was more customer focused. Yeah, so that's what we tried to do.
And possibly you must have been like number 2 then in the UK, because RateSetter didn't form for a few years after you.
You may not remember it. There was actually a company whose name escapes me now, but I think they changed their name to Yes Secure, who started just before us, and we were quite worried, but we shouldn't have been, because they sadly didn't do a very good job. But yeah, so Zopa had been around, they'd done a lot of great work. We then launched, and then about a month or two after RateSetter launched, we were fairly close. They were working on it at the same time as we were.
But they weren't going for as we'll come on to the main meat of the show, they weren't going for the tough challenge of SME lending.
Sure, and I think although the business models, and we get talked about in the same breath as these players, the business models are very similar from the operational dynamics. The actual meat of the business, which is distribution and creations of credit to small businesses, is quite different from individuals.
Yes, and at the time, going back to provision-based models, which is what RateSetter introduced, to marketplace models, which is what you guys have been throughout, Zopa was, in those days, a marketplace model, wasn't it? So
Sure.
You passed it through, and they'd only later turned into a provision model.
Sure, and it's something that we've thought about a lot. I suppose our view of it always has been that marketplace models are a more correct way of presenting the business to the investors, the people who are putting up the money. And the danger that you have with a provision-based model is that you either provide too greatly and not able to return money, or during difficult times, the provision fund isn't sufficient. And that's very hard to communicate to investors, I think.
Absolutely, as I've been writing about this year, and we'll come on to later in the show some of the bleeding edge issues in peer-to-peer lending, marketplace lending, that maybe have been solved in a few years' time or not. But at the moment, there's a kind of Darwinian competition going on between the models. And certainly from my perspective, I really like the simplicity and clarity of the marketplace model. I turn up and I buy large eggs, medium eggs or small eggs from you, and I get that. And I get what I get, and there isn't the obfuscation in the middle, although it does have its place. And as I always say, I'd probably send my mum towards something like a RateSetter if she was going to put her money there for a year, rather than get her sort of buying A's to E's or whatever you have now, and auto bids and all that kind of stuff that might confuse her. But there are a lot of financially sophisticated people out there with money these days to whom your proposition is more appealing. So moving on to SME lending in a fintech world, you would describe me a little bit about why the gap exists, which in part is 2008 financial crisis, and bank lending to SMEs is still contracting now 7 years afterwards, perhaps surprisingly or not surprisingly, given the legislation and regulations being heaped on the banks. So in terms of the whole SME lending, regardless of whether it's by old financial services companies or new financial services companies, how do you see the gap there at the moment that SME is it moving its troops into? Is there sort of white space on the map you're going out there and conquering, or are you just elbowing other people out the way?
So my thoughts are basically that I think small businesses for some time have been misserved or underserved by existing financial players, and I think that was exacerbated by the financial crisis. But frankly, there'd been a lack of, in my view, true product development in that space, and really kind of thinking about what the customer wants, needs, and how do we go about supplying it. Clearly, we can't just give loans to every single small business. Life doesn't work like that, but we should be able to provide them with a service that it was better than they were experiencing. And that's about execution, speed, certainty, understanding the process, access to decision makers, things like that. So I think there's a gap to frankly just serve businesses better, and that's what we're looking to fill.
So that comes back to the whole fintech idea in the first place, doesn't it, in 2009, of having a consumer-focused business. And of course, a million years ago, banks started by being consumer-focused, but then over time, and especially over the massive consolidation in the last 30 years, where they just got turned into vast organisations, once you're a vast organisation, most of your focus is internal, as I know, whereas if you're a small business, then most of your focus is outwards looking. I mean, just taking a simple example of me doing a podcast, I can't really talk to myself about very much. I get bogged down in my own bureaucracy. I've got to get out there. But once you're 330,000 people like HSBC, most of your conversations are actually purely internal, just in terms of the dynamics of it. And no doubt that's a challenge that you guys will sort of slowly face as you grow up as well. So in terms of SME lending, there's a wide variety of listeners to the show, some of whom lending to SMEs themselves, some of whom don't know about it. But I think the soundbite is that SME lending isn't simple. So why isn't it simple? And without giving away all of your secret sources, what do you think are the sort of key angles which you've used to crack the nut pretty successfully so far, I should say?
Yeah, sure. So I think you're right. I think lending into small businesses can be rather complex, or lending into any business. But clearly, when you're lending into a small business at smaller ticket sizes, there's only a certain amount of resource that you can allocate to diligencing and understanding that business.
What range of loans do you make then to small businesses? Let's say I'm trying to raise money. Will you lend me literally £1,000 or 10,000 or 100?
We'll lend in the UK between £5,000 and actually £1 million. But if you look at where the meat of our market is, it's really 25,000 to sort of 150,000. So we need to understand how we can lend into those types of businesses. So, around $1 million turnover, that group of businesses successfully and efficiently, providing a product that works for them.
And just going through the obvious but implicit arithmetic, I mean, if you're making a 25 grand loan and let's say you make 1 or 2% on it, you're only talking about 250 quid, 500 quid margin anyway. So you've got to have a process that, quotes, costs less than that fag packety to deal with it. Otherwise, you ain't going to do it, which is one reason that the banks can't serve those small sectors, because their overheads are so vast in the first place, legacy systems, yada. They'd be losing a fortune.
I think that's one of the key challenges, and so you have to use, and frankly, the approach has to be, how do I understand businesses quickly? And obviously the foundation of what we created is, let's look at the data and information of those businesses, and we create models to try and understand the risk, and then we couple that in ever more efficient way with individuals who then underwrite the businesses in tandem with the model. And I think that's a really important part of the way that we do things.
As you say in your LinkedIn profile, it's all about organising data in the modern world. Just to clarify one point here, which should be obvious to everybody, but actually the minutiae aren't always obvious. When you say that you lend the money, of course, in a platform sense, the money comes from a lender like me who sticks my money and it goes to the other side. Although in practice, with things like Lending Club in the States, they actually have a bank intermediating, so there is actually a lending process going on. And with models like LendInvest, they actually underwrite the thing themselves. Just on that small point, how does Funding Circle do it?
Sure, absolutely. And thanks for pointing out, actually, Mike. So, yeah, we don't lend the money. What we're providing here is actually a service which essentially interprets the information and data that businesses presents to us, and then provides a risk grade that then investors decide to lend money to the businesses or not.
So that's it, obviously, in the UK. And is that how it works in the States? Because I've forgotten the detail, but I've forgotten the name of the bloody bank. But there is a bank in the process in Lending Club in the States. And when I last looked, Lending Club wasn't yet authorised in 52 states, because America is 52 states as well as a country. And is it the same transparent, see-through process?
So in the States, and it's largely to do with the regulatory structures, we started off by having institutions lending only at the beginning, and we actually had our own fund. We actually launched recently the ability for equivalent to the UK's sophisticated investors, so accredited investors, to lend in the same way as they do in the UK. Yeah.
Oh, interesting. So on the data point, so my understanding, again, just from a very high level, is that one of the reasons that SME lending is tougher than consumer lending is that, quotes, you can get less data points on an SME.
So I think
is this true?
I'll put it the other way. I mean, the way I think about it is an individual or a consumer that's lent to, they have their personal finances and generally will have a job with a relatively steady income. With a business, it's perhaps more complex. Usually it's a number of different people, could be a number of different directors with their own personal finances, which equally impact the business, and they're symbiotic, the business finance and the individuals behind the finance. And obviously the business is more complex generally, and how the income is is dealt with in the expense base. And so actually, where people talk about the difficulties is that the richness of data for a consumer is there, and it's taken time for that richness to exist in small business lending. But the bureaus now are collecting relatively rich data from banks to be able to lend into SMEs. And obviously, one of the other very difficult things is that the number of loans that you do in SME lending is just frankly lower because the ticket size is larger. So therefore, to build statistically relevant models becomes more difficult because you have less observations of both doing successful loans and loans that fail.
And what's your average maturity of loan, roughly?
It's about 43 months, I believe, at the moment. So on average, we do loans from 6 months to 5 years, but most loans are 3 or 5 years.
Right. Anil was talking on the podcast recently from Market Invoice about one of the interesting things about his segment of the marketplace being that the maturity is 40 days or something like that. It's so much shorter. So he's got so many more completed transactions. Although the book is smaller, which leads to its own issues around rental income and all that kind of stuff, they get so much more data points.
That's interesting, because I did actually listen to that podcast. So the key thing there is, yes, that's true, and until the end of the maturity of the loan, you can't be absolutely certain of its complete success. Yeah. But actually your first 12 to 14 months of performance in the portfolio is hugely correlated to the overall performance of that book. And we're starting to see the evidence there. So as long as we can see that performance at the beginning, that signifies what we expect that portfolio to look like over the long term.
That's very interesting, because going back in the day before this sort of stuff started happening, in the early 90s, I had one or two good ideas on risk, and one of them, which sounds very trivial now, one of them was actually to go to the credit department, a client once, which in those days just had 1 million files on the wall, and go and collate them all into how many A's had turned into B's last quarter, how many B's into C's, and do some statistics on that, which of course was thought was a really sort of strange thing to do. I mean, of course, it can mean nothing, kind of thing. But fast forwarding to where we are at the moment, we'll come back to credit modelling in a minute. But one of the things that you guys do very well, as far as I can see from the outside, is actually just look at the statistics of how well your machinery is performing. A bit like a Formula One engineer. He's sitting there with all his laptops and plugging them in and that kind of stuff, and you know what the temperature of this, that and this, and you can tune it. And you guys seem to do that very well. And one of the prime examples, I think, that's available in the public available information is in terms of the credit performance of your early portfolios compared to the later portfolios. So off the top of my head, in your early days, the losses, I can't remember, were something like twice the expected, and more recently they've been running much more in line with it. So is that a question of tuning in over time?
I think that frankly is that you get better over time, and as the marketplace matures, you understand more and you can serve businesses better and frankly investors better because you have more confidence and certainty over the performance. I mean, we at Funding Circle actually track every single business in the country, and the businesses that come to us, whether they take a loan or we reject them, or perhaps we offer them a loan and they reject us, we continue to monitor, because it's publicly available, whether those businesses survive. And so it's a very important part of our definition of success is, are we differentiating correctly? Because you could improve your performance, but actually that improvement is just because market conditions meant that better businesses turned up through the door.
Rising tide.
Absolutely. And so the key thing is to say, well, we had this opportunity with these businesses. These are the businesses that we offered on our platform to our investors, and these are the ones that we didn't for credit reasons. And did those businesses perform worse from a credit perspective? And we've consistently got better at doing that.
And I'm not sure what's sort of in the public domain, but I mean, I do have from somewhere the statistic in my mind that in the early days, the success of the businesses who accepted, the ones who rejected, was roughly 1-to-1. And presumably that ratio is something that's improved.
Absolutely, and it continues to improve.
You can feel free to tell me the ratio if you want, or feel free not to tell me the ratio.
I don't know exactly what it is at the moment. It's just more like a 3 or 4 to 1, and I'm not sure if it was 1 to 1, but I'll let that stat slide. But I think we've always been successful at it, but it's certainly the case that we are become more successful.
And going back to looking at the statistics of how credit works over the life cycle, I was interested / surprised to hear you say that the early period is a good predictor of the longer term, because again, when I was looking into the detail of this, which is quite some time ago, basically loans tended to perform quite well in the early days, early years, and then fuck up later on. And in those days, 20 years ago, different marketplace, yada, maybe not enough stats, etc. But even on things like Standard & Poor's curves and all that, I didn't actually notice back then that there was much predictability of the early performances with the later stuff, but obviously you've found that there is.
I mean, you just have to look at our curves and look at when defaults happen to be able to see that. And I think absolutely the case that you have defaults later in the cycle as well, but the performance in that early part is very important. There's very, very broadly two categories of characteristics. So you can look at a set of characteristics at origination, and they can really help you understand what that business is going to perform like in the next perhaps 6, 12, 18 months. And then there's other characteristics which really are better at indicating later, but combined, how you see that curve work and when defaults happen, that performance at the beginning indicates how that performs later on in the cycle, and we've been able to evidence that and start to see that happening for us.
That's interesting, and that leads quite nicely into the whole thing about credit risk models. And one of the advantages of an established company like yours that's been going for 6 years is that no doubt you've been able to iterate many times. And you say, listening to Andal and Market Invoice, I forgot what he was on now, but he's on his 4th credit model or something like that, compared to if you're a new P2P or marketplace lender starting today, you're on model 1.0 and you rather hope it works well. The challenge with risk modelling as a whole, I don't know how to explain this to people, many of whom will know more than me, or many of whom may know less than me, is if you're modelling anything, there's a problem of overfitting or underfitting. So if you take the past statistics, you can probably produce some model which shows you exactly which horses won races perfectly, or like with a really high correlation in the past. But the chances are that model has overfitted the data, as it were. It's like, say, you got dots on a chart and you drew a zigzaggy line when actually the real trend was a straight line. And a model which is overfitted to the past will tend to perform poorly tomorrow. So that kind of model will perform poorly on betting on horses tomorrow, as opposed to a model which is more sort of smoothed it out. So when it comes to this whole modelling thing, I wrote an article for AltFi called 15 million Google results are wrong, because there were 15 million articles on the interweb about how you can measure risk, and I was making the subtle but very important point: you can't measure risk, you can only ever model it. How do you deal with this problem when you come to data? Because you say the companies that organise data best are going to win. There's more and more data points out there. Before you know it, you've created this perfect model, a zigzaggy line, which is a perfect model for the past but not for the future, as opposed to a bit more crude models of the past tend to generalise better into the future.
Sure, and obviously, as you know about modelling, is the whole premise of modelling is that the history and past performance has a guide to the future, and if that's not the case, then no model will ever work, and largely that always is the case.
What, the models don't work, or do work?
They do guide you to the future, and you see cycles, and we've evidenced that, right? So, but absolutely, so what ends up happening is you actually need a bigger set of data, right? So because if you build your model on all the data that you have, then yes, you'll do what you're talking about, which is you overfit, and I don't know, think of it like a piece of clothing. If you fit the clothing perfectly to the person when they are 10, and then when they're 15, it doesn't fit at all. But sometimes the body shape still stays the same, and it's just a size or whatever it might be. So yeah, there's lots of techniques out there, and outer samples testing and things like that. But that's a really important part of understanding the quality of the model, because I could build a very good quality model today which will overfit and degrade over time. So degradation of those models and how quickly that happens and in what way is a real indicator of your success in building models.
So this is presumably why your co-founders don't let you out of the office very much, because you have got your head under the bonnet.
In some of the detail.
You're now hiring people to do the work for you.
Absolutely. Far better people than I are executing this.
And I think actually it's another subtlety that we'll come on to later, which is that there is value in a hierarchy, because it's very difficult to be strategic and tactical at the same time. If you have got your head under the bonnet, you tend to be looking at sort of the detail, and if you're further away, you tend to be looking at the big picture, and increasingly you need to look at both, particularly when it comes to this modelling. And one of the challenges, I think, for people in the marketplace, listeners or people who lend through platforms, is really measuring one platform against another. And one of the issues there, presumably going back to the time horizon, is that, roughly speaking, if you're going to start a new peer-to-peer platform today, you presumably go to Experian or one of these credit bureaus and you get some stats and you start with those as the sort of rough starting place, and then gradually over time you add on to them, subtract from them, build your own model and gradually displace them completely. Is this your feeling?
I think what you talk about is exactly right, which is you have to stand on others' shoulders when you first start, and that's often the best way to do it. And it's very difficult for a competitor of ours with less information and data and performance and knowledge about what they should expect to be able to compete in terms of risk measurement. And I think, frankly, it's an attraction of the business to business owners, is that you create a lot of intellectual property and understanding by going through that process and making sure that you're successful in it. And so it is difficult to compete with companies like us now.
Which is another trend which leads, in my feeling, for this kind of sector moving to an oligopoly ever faster than sectors have gone to oligopolies before. I mean, I just always tend to think of Funding Circle, Zopa, RateSetter as pretty much the top three. I mean, I'm not dissing anyone else, but if you're one of those that were going in the last decade, then you've got 5 or 6 years of successes, triumphs, cock-ups, mistakes, etc., etc. And they're similar in the FX B2B world with likes of Currency Cloud who've done 10 billion and Candox have done 1 billion. Once you've done that kind of stuff, it's very difficult for me to come along and start beating you all because I just don't have that experience. I just haven't been around the sort of track that many times.
Part of what you're saying is true, and obviously when you say that, everyone's like, oh God, that has to be a negative thing. Clearly you have, for example, how many London Stock Exchanges are there? How many...
Or Screaming Lord Such says, well, why is there only one Monopolies Commission?
Yeah. Well, so look, I mean, so these things are observed elsewhere. I think the key behind what we're doing is we are a platform, a marketplace. We're open to all types of participant, whether they're investing. We're open to all types of customer segment that we serve, which is small businesses. So I agree with you that you end up in marketplace models having dominant players, and I think you'll probably see that in financial services.
Yeah, exactly. There aren't that many eBays.
Exactly.
There aren't that many Amazons, in a sense, if you call Amazon a marketplace. And I think the countervailing force to that, which is that the oligopolistic ones, the ones that are doing so well, have got all this track record, tend to attract all the money. And the money is quite a good thing sometimes, but the trouble with money is it can burn a hole in the pocket. And when there's a race towards asset growth, the thing that concerns me slightly is when platforms move in credit modelling terms to out-of-sample stuff. They've been really good in a vertical, they know a hell of a lot of that, and they go into another vertical and think, oh, this must be like that. And it's similar but different. So managing that growth profile must be the challenge for you at this stage.
There's some things that you can take quantum leaps in business on, and there's some things which are best served through iteration. So if you look at Funding Circle, who are entirely focused on a global level on businesses, and we believe that's a core skill set, both in being able to distribute and communicate to those businesses and the credit risk assessment. So we've always focused on that. And if you think about our track record in terms of opening up risk grades, I mean, actually, one of our investors, we had an investor even came up to me and said, do you deliberately do it like every, I don't know what it is, a year or 18 months? And I was like, no, it just happens that way.
When you say opening risk grades, you mean having a new one?
Sorry, apologies, yeah. So so when we launched, we had A plus A, B, and then we added C, and then we added D, and now we've just added E. And the whole idea there is to really understand the part of the market that you're not currently serving in your risk spectrum. What does that look like? What does it perform like? Get some history there, and then introduce that with more certainty and knowledge.
So it's incremental change. You haven't suddenly gone into, I don't know, unsecured consumer lending in Korea, for example, which will be so different. You've got no correlation.
And I'm not saying it's impossible for marketplaces to do that, but I think some things are better served through iteration. I think certainly some of the risk stuff is.
Absolutely. So that moves on to just wrapping up on this sort of SME lending. As you say, you guys have done it pretty well so far, and touch wood, you carry on doing it pretty well for your investors. The bleeding edge of fintech, and fintech's always evolving, which is the nice thing about it. Issues that I think in 2 or 3 years the market will have evolved to a solution one way or another to, I see are for the provision fund models, that the provision fund can smooth the returns out, but the problem with provision funds, as banks have had provision funds for centuries, is that generally you've got too much and then every now and then you've got far too little, and that's a challenge for the investor, and that's not necessarily for us here. But the marketplace lending model, I see the challenge there as this grading thing, that you're grading eggs into, shall we say, large, medium, small, and if it's eggs, I can open a box of eggs at Waitrose and go, blimey, this is 6 small eggs, I thought it was 6 medium eggs, and it's quite easy to spot. Looking at the people with the biggest resources in the world, the Standard & Poor's and Moody's have got lots of resources for grading and assessing credit, and they've been at it for decades and decades, and lots of internal experience. Pardon my French, but of course one of the prime reasons behind 2008 is that those guys fucked up completely. They said these are large eggs, and they turned out to be really bad small eggs, all sort of AAA stuff. And again, looking at this from the perspective of outside, if you're a lender into the platforms, on marketplace platforms, let's say you're lining up your 3 platforms, you'd really like some way of knowing that, platform A, 95% of the time it says something, it's an A, it is an A. Or 95% of the time it says it's an E, it is an E. Or 50% of the time it says it's an E, it wasn't an E. And what does an E mean? All that kind of stuff. And from the outside, I find it really hard in the fintech world to be able to compare the marketplaces, yeah? How well are they actually grading it? Just in the same way, I find it really hard to compare Standard & Poor's and Moody's, how well they grade it. So that seems to me a challenging subject, which financial services as a whole, old and new, hasn't got a handle on, and certainly got a history of 7 years ago fucking up on. So how do you see that issue from the inside? Not to bowl you a short pitch ball or anything.
No. I mean, look, I think these things are the real challenges. And ultimately, the way that we've really attacked that and tried to deal with that is through being as transparent and open as possible, right? So provide as much information as possible. And you will see us incrementally increasing that and providing more and more information as possible ultimately. And performance is open. So if a loan is late, then you could download the loan book and see that. And I think that's a really important thing. And in terms of the models and exactly how S&P decides on a risk grade, you need to have a level of transparency around that. And I think for us, how that transposes onto Funding Circle is being able to look at key performance indicators and being able to track that. And I know some investors do that, and those who want to be engaged and involved do look at certain things, I don't know, maybe average turnover or like profitability and things like that. And people won't know exactly what makes up exactly what's in our model, but they will know that these things are important from a credit perspective, and they will be able to see whether they're consistent for our modelling. And I think that will become really, really important. Even if we were to, I gave you our full model and said exactly how it worked, we wouldn't be able to communicate with every single person exactly what that really meant. So we have to find ways of doing that. And obviously risk grading is a key way. And then obviously being transparent about, were we successful in risk grading? What did that look like? Were we successful generally? And I think that's the best and only way to do it.
Yes, well, I think that, in my opinion, that Funding Circle have got the best and clearest information out there of all the UK platforms at the moment, in terms of a number of dimensions of the actual risk, by which I mean, people put money in and what do they get back. So you've got some really good stuff out there on the importance of diversifying your portfolio and what it looks like if you can invest in 50 or invest in 100 and all that kind of stuff, and it's very useful. And I hear what you say about the likes of Standard & Poor's, that maybe they need to make more transparency. Most of the people I know that have been in the city for ages are amazed that Standard & Poor's and Moody's got away with such tiny fines in America compared to the 20 billion of fines of the banks, given that they were a large part of the problem along with the banks. But that's another story for another day. I wouldn't say at all, I wouldn't be a proponent of you guys having to reveal your model, because that's the secret sauce. That's what you work really hard to do. I do, however, think that there is this gap in the market, whether it's provided by you or Alt5 Data, who have got all the portfolios of the leading players now in great granularity, and I've downloaded them. I thought, oh shit, there's a 1 million line spreadsheet, bloody hell. That's definitely too much information. I don't know. I suspect that the answer to this is actually, like most of these things, a fairly simple thing, which is that, historically, this is what our A's have performed like.
Absolutely.
Just a distribution curve. This is what our A's have looked like. This is what our B's have looked like. And certainly last time I looked, it may have changed, but I was quite interested that actually, for all the alleged sophistication of lenders through the platforms, it ain't that sophisticated. So what I've tended to see is that if you take the expected return minus the expected losses across A's to E's, shall we say, they tend to be a fairly flat curve, which to me is wrong, because the uncertainty increases as you go down. So for the sake of argument, just take a AAA. So if you lend to a AAA, you shouldn't really have any defaults. If you lend to a triple C, you can expect a high level of defaults. Not only that, but the high level of defaults can really vary over the cycle and can be uncertain in the first place. It's like a sort of cloud, it's like a mist.
Correct. And I mean, we've tried to address that. So I don't know, I don't quite, when we did it, maybe it was a few years ago, about a year or so ago, we introduced minimum bid rates. And part of those minimum bid rates was trying to begin the kind of education, as it were, to explain that actually there should be a premium associated beyond the expectation as you increase your risk, right? And I think, again, it's our responsibility to make sure that that's communicated. We need to be careful that we don't do it in a way that completely depowers investors. Very important for us to do that. But we believe transparency, openness, communicating clearly is the way to get people to understand these things, and where necessary, we'll bring in things like minimum bid rates to sort of force the issue, as it were. Yes,
well, it's an interesting question. I mean, we're not pretending that everything's solved today, and the interesting thing about the sector is it's moving on. And, we're also getting this narrowing between old FS and new FS. So recently there was, whatever it was, $437 million securitization AAA of SoFi loans. And I thought, oh, here we go again. And given that one doesn't know everything about loans through platforms, SoFi being the American student loan P2P, before you know it, you're back into securitizations where Standard & Poor's can't know as much in the first place, and how can they be certain of AAA? And it all gets a little bit circular. Anyway, it's all entertainment. So I think that's very interesting about the SME lending, Andrew. And wrapping up, so where's Funding Circle at now, and where's it going, and all that kind of stuff? Because from the outside, you guys are doing really well the money's flowing in and nothing's going wrong and all this kind of stuff. And so the only thing you should be really worried about is hubris, which is that whenever everything seems to be going fine, there's a storm that comes along.
Well, yeah, I'm not quite sure if I quite put it in that way, but one of the kind of things that we're doing now, we announced recently, for example, that I've just hired a global CRO, and in fact, a few months ago, I'd hired someone to look after the US business. So
you're not going to have to fly so much now, no?
I probably will fly, but probably be doing different things within the company. I think the important thing, and like all founders of businesses, and this is a key thing, is to understand that you can provide value to the business, but you also want to employ technical skills, especially that's better than yours. And I've been able to do that beneath me quite successfully. And then in the case of Jerome, who's going to come over from Barclays, you sometimes have to move aside when that leadership in that technical area and execution is right. And it's a privilege as a founder to be able to attract someone like that and be able to support them through taking up that role. So yeah, he's coming in as a global CRO, which is really exciting.
And I think that's an interesting thing, because my 50-something buddies who didn't get out of old FS in the risk world, they're sitting on risk committees of insurance companies or building societies or the like, and they're non-executives, and you have a non-executive on the board chairing a risk committee of the board that takes a more sort of grey-beard view of somebody who really knows what he's doing, but actually asks some questions of them, in just a bit more detailed way that we're being sort of kicking it around today. So I think having that dual layer in a company like yours does actually add the belt and braces. Because if there's one guy, how can you sort of study yourself? How can you look over your own shoulder?
Sure.
How can you ask yourself questions that you haven't thought of? You can't really.
Sure.
So I think that the P2P marketplace will evolve in that direction as well eventually. And I think the regulators will get around to saying that, ultimately you need a risk committee on the board.
Yeah.
Asking questions of the bloke who does it every day of his life. And that's kind of where you're going in a sense, isn't it?
Not many startup tech founders talk about this stuff, but actually good governance becomes important.
Yes.
And I genuinely mean good governance, not just necessarily out the box.
Bureaucracy and pieces of paper,
Yeah. So we have to kind of embrace that, and we have done that especially within the risk management of the company for a while. But yeah, we just need to make sure that we keep on top of that, make sure that we lead the way.
So going back to having loads of money to spend, Andrew, and if you want anyone to come and help you spend $150 million, I'm always available. I like spending money. How are you guys going to spend it? You're going to grow a lot in the US? You're going to go to other places in Europe? You're going to just, hire more CROs? All of the above. Are you going to get a fountain in reception and the bust of the sort of co-founders?
Well, sadly, the co-founder jet. No, I'm really kidding. On a serious note, look, we raised the funds because we think that this business is going to be transformational in financial services.
Yep.
And to take that opportunity properly, you need to make sure that you've got sufficient financial resources to do that. So absolutely huge investment into the States. We are considerably smaller there still than the UK, and that market is 8-9 times the size of the UK. And I think, as we said before, our ambitions are to be global, multinational, whatever you want to call it, business. Well, I don't think only having 2 locations is going to cut it forever. So I think there'll be other countries that come on board as part of that in the future. And I think that's part of our ambition, is to build that. And these things all need resources to execute properly. And that's what we're going to spend the money on. You're always super conscious. I always worry about what you're like before, Like we wouldn't get a handyman in to kind of change a light bulb, we'll do it ourselves. But I think some of those things you have to be a bit more practical about as you get a bit larger. But equally, I'm not sure if spending some money on a fountain or something like that, or a piece of artwork, will ever make absolute sense, unless it was perhaps a fountain that was constructed by one of our businesses, or I don't know. But
yeah. Well, it's traditionally the sign that sort of companies lost the plot when they start doing that kind of stuff. So when we start seeing sort of busts of you all in reception, we'll know that it's time to sort of sell and get out. But certainly in the meantime, 150 million sounds a lot of money, and it is. If I woke up and got 150 million tomorrow from the lottery, I'd feel it's quite a lot of money. But putting these things into context, it isn't even a drop in the ocean compared to a bank's capital or the valuation of lending clubs, or however much money goes around. And before you know it, if you start growing serious businesses, that burns out fairly quickly, actually.
Yeah, I think it's an absolutely large amount of money, but it's to take the opportunity. I think it's a reasonable amount.
Well, thank you for that, Andrew. It's been a very interesting conversation. As always, time's flown by, and there's been lots of sort of interesting things that we could have spent an afternoon talking about, diving in. As I said at the beginning, Funding Circle is a globally recognised brand, talking about countries I was very pleased recently when Azerbaijan downloaded the London Fintech podcast, because I'm now to 97 countries. I need 3 more countries for the 100, which will make me very happy. And I really want somebody listening in Greenland, because there's this map of the world of where I've been downloaded, and Greenland on the Mercator projection is huge, because it has stretched at the top. So when I get Greenland, I'll be very happy. So anybody on the show that's flying to Greenland, please download it and make my day.
The sun never sets.
The sun never sets on the London Fintech podcast. So that's the good news. The bad news is I seem to have made a fundamental business mistake myself, and I sell these at $0 a go. So at the moment, I'm getting sort of over 30,000 times $0, which is still $0, but that's my problem. In terms of funding circle, I really respect you guys as professionals. I respect the journey that you guys have come on. You couldn't have possibly imagined it, I'm sure, in 2009, and it's going incredibly well so far. You are market leaders. You are providing more information. It's something that everybody should be looking at, both in terms of potentially putting your money in there and also definitely borrowing money. And I wish you every success in the future, and I hope that the next 6 years are as productive as this. And going back to what you're saying on LinkedIn, if you do that, I know that you'll be changing a lot of people's lives out there, because lending to SMEs not only keeps SMEs going, but that creates employment, and creating employment to me is more important than creating wealth for a few people, because there's 35 million people unemployed in Europe. So that's a social good. People can often think that finance is just something to do with numbers and all that kind of stuff. It is, but actually it does change people's lives. And as I said at the beginning, if you guys make some money out of it, well, good luck to you, because you've changed the lives of many, many people by the time you get to this Fabon IPO. So I wish you every success, and thank you for today, Andrew.
Thank you very much, Mike. Really appreciate it.
Thanks for listening. If you enjoyed the show, please subscribe on iTunes or your podcast app, or sign up at londonfintechpodcast.com for email alerts on new episodes. Live long and prosper.
We could sit in a bender all day, watching the firelight dance, watching the firelight dance. We could walk in the mountains before dawn, watching a happy moon ride, watching a happy moon ride. Come away from the city, with the tarmac so dead and the people so sad. Come away from the city, with the faces so grey, with the pain of the everyday. We are wild like the mountains and the trees. Can you see what I mean? Can you see what I mean? We fit in between the earth and the sky. Kiss the city goodbye, wave the city goodbye, wave the city goodbye. The city goodbye. Watch the firelight dance with me. 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 Watch the firelight dance.